Introducing the man behind one of the largest prop firms in the industry, and with nearly 2 decades of market experience, he has walked the walk as a trader.
The way I approach the market is I divide my entry into different small trades, and then I manage all those trades as a whole setup. So that gives me flexibility, and that active trade management, adding to wins, adding to losses, you can make the whole setup a more profitable one. And that's what allows me to keep a very high win rate.
Introducing Saul Lokier, the CEO of The Fivers and a seasoned scalper in the market. In this episode, Saul unveils not only his trading strategy, but also reveals the leading mistake that causes most traders to blow accounts and the simple solution that those who achieve payouts actually do.
It's becoming easier with AI and machine learning to understand if a trader is going to make for a payout or not.
And just out of curiosity, which ones have you found to be more consistent?
That's very clear to spot and to see and to explain, because a profitable long-term scalper requires more management, patience, discipline. Most of the traders are not there yet. So most of the traders I see making payouts and getting into larger accounts are swing traders, which just requires, a good signal, a good entry, and then letting the trade go in your favor.
Maybe 20 or 30% of the guests I've had on the show speak bad on prop firms. I'm a big fan of prop firms. I think they're a great tool. Yes, there's denied payouts. Yes, there's people that got scammed, rug pulled. I'm not denying that. But at the same time, there is people that are 18 years old, made $30,000, life-changing money. There is wins and there is losses in this space. But overall, I think it's a net positive. For someone that is watching, what would you say to them? So let's get into, first of all, the 2010 era. Yep. So this is before even I came across trading. I started in 2015. But as you said, the social media presence wasn't there. The marketing wasn't there. It was probably harder.
Yep.
But at the same time, someone can look at the industry now with the mess that it is, with its pros and cons, and say it's hard now. So now that you've seen the industry navigate for more than a decade, how do you view the social media elements and just the ability to learn and find correct guidance compared to your era where it wasn't the same?
Yeah, so I think the same problems we have with social media today are the same we had back in the day, which is creating unrealistic expectations on traders to what's achievable consistently. You see the flashy, you see the cars, you see the Lambos, you see all of that, and it always looks like it's easily achievable, and it's not reality. When you start trading, it takes time until you understand what you're really doing and your strategies inside out. And if you don't have that mentor to really guide you on the blind spots of being a trader, sometimes you win money and you don't understand why you're winning, and you lose money and you don't understand why you're losing money, because the strategy, you're performing the same signals, the same strategy, and you don't understand why sometimes works and sometimes doesn't. So I think those are the blind spots that takes a lot of time for traders to even understand they exist. The FOMO and the over trading, and am I using the right strategy to my profile as a trader? Am I using the right strategy at the right time? Maybe I don't have, my profile is not being a swing trader.
You mean based on personality?
Yeah, personality and psychology.
How would you connect these dots of personality type or psychology type to how someone should trade to their own strengths?
That's the question. Everyone's different. Everyone's reality is different. So you might have a different trading session. If a Forex trader, you have all day available for trading, but maybe you have a job or something. So you have little screen time, or you have the whole day for trading. So if you're going to be scalping, you better have more time to trade, right? If you're going to be just doing position trading, you might not be doing Forex. You should be maybe trading stocks. The Forex market is very rangy. So understanding which market, what time frame, if you're going to be position trading or scalping, that takes a lot of time. And if there's no one there to guide you on what's your individual situation, what's your individual reality challenges, blind spots, and help you overcome those, it takes a lot of time to figure that out by yourself, right?
And what worked for you in the end? Which approach?
So I was there, and I was, I discovered a guy who used to taught trading pin bars on the daily charts. And you were supposed to hold your trades for days until the daily candles open and close. You would hold your trades for weeks. and I couldn't sleep at night. Just think on the P&L. As you
Okay.
grow your account, you have thousands of dollars floating or hundreds of dollars floating. I couldn't sleep properly, and at some point I understood that wasn't working for me. Okay, I used to close the profits early, or I used to leave the losses run more than needed. And slowly I understood I needed to go to lower time frames. And slowly I went into scalping. Today I scalp even the tick chart. I hold there's a trading room for the company, and I join the trading room every 2 weeks or every week, and I show what I do there, and I trade the 1 minute the 1 minute chart.
You went from the opposite end daily.
The opposite end,
Okay,
and
okay.
I'm aware it's not the most efficient way of trading. When you scalping, you pay a lot of commissions and you pay a lot of spread, and you work harder. And you take little profits every time. So you work hard in order to build your account up, but it's just the way it suits my personality, because I can open a session, manage my trades, and end the session. I don't need to leave them open for longer. I don't need to go to sleep with a trade open. I don't need to do that. So even if that's not the best way to trade or the most efficient way of trading, is the best way for me, and I'm successful.
It's interesting because, of course, there's pros and cons to swing, and we can call it hyper scalping, even. But there is, for example, personality driven. So in your case, you probably felt the weight of, I enter a trade on the daily time frame, and for 3 days it's consolidating on my entry, and that's thoughts every day. Oh, then maybe it goes towards your profits, and you're like, great, I'm seeing big numbers now. But then a healthy 50% retracement. This is normal. But then you see the numbers going down, and I guess this roller coaster was not something for you. When it comes into the lower time frame scalping, I get what you mean by it's more work, because there's more decisions to make in a shorter amount of time. But on the flip side, there is also, you can gain the same risk to reward instead of days or weeks, it can be done in minutes. So you have quicker feedback. You have, depending on your beliefs, but more clarity on the lower time frame. Now that you've had a taste of both sides, apart from your personality or your preferences there, from a technical perspective, from a trader watching, what would you say are the pros and cons from someone who is daily time frame swing trading down to M1 scalping?
Again, I think there's pros and cons for all styles and all time frames, as long as you understand what are the statistics behind each one of the styles, and you understand them and you embrace them and you're willing to work with those stats, you're good. For example, I scalp, and I know my strategy or my style of trading has a break-even, slightly negative risk-reward ratio, for example. But I keep a very high win rate. 80 plus win rate.
So you're a good trader is 1-to-1, or maybe even less.
Yeah, correct.
Interesting. Okay.
So I win. I win a lot of trades.
Okay.
A lot of trades. Dozens, hundreds of trades. But when I lose, I might end up losing. The whole setup. I might end up losing more than my wins.
Very interesting.
So I'm fine with that. I live that reality, and I know as long as I'm keeping my high win rate, I'm good. If you would, when you just open YouTube and you listen to someone, you will always hear try to keep both high, right? A high win rate, a high risk-reward ratio. I've seen very few traders, and from my position today, I scan thousands of traders. Very few traders that can keep both ratios high consistently and long term. So there's always a trade-off on the trading style you're using, and as long as you understand the reality and the real long-term stats of both, and you can keep to them, and filtering out the bad setups and just sticking to the A+ setups and performing well, I think the pros and cons they just come down to screen time, efficiency on training costs, decision making, speed, all of that. But again, it all comes down to what's best for you.
Let's take a moment to talk about a partner of the show, a leading prop firm, that is FundedNext. And it's important for me to listen to our community to see who are you working with and how can we make your experience better. And the main feedback I heard is trusted payouts, quick payouts, ability to scale, and affordable prices. And FundedNext has ticked all of those boxes, not only being a top 3 prop firm in the industry, but also having on-demand payouts, and every 10% you gain on your account, you will double your capital for free. And because in this industry, trust and reliability is the most important factor. An important guarantee that they have is that if you do not receive your payouts within 24 hours, they will gift you an additional $1,000 to your payouts just for being late. So to unlock all of these benefits and work with a leading prop firm in the industry, FundedNext, check out the link in the description or use the code TOT.
No.
Do you believe that a high win rate and a high risk reward, are they something that they are connected, that once your win rate goes high, naturally your risk reward has to go lower and vice versa? Or is there people that you've seen, or is it a truth in the market that you can sustain both to a high level as long as you master something else?
I just know what I see, from all the accounts. I know the traders who have very high win rates, they tend to have a 1-to-1 risk reward ratio. And traders who have very high risk reward ratios, 3-to-1, 4-to-1, even 2-to-1, they have a break-even win rate, or even negative, they're both profitable, right?
Yes.
But I've seen very few trades or traders having, a 3-to-1 win rate and a 70 plus or 80 plus, 3-to-1 risk reward ratio and 70 plus, 80 plus win rate. I've seen counted ones.
And in terms of, let's just say, longevity of a trader,
Yep.
because I'm sure you've seen people that are consistent for 2 weeks, 3 weeks, and then blow an account, or others that are consistent for months and then somehow blow an account.
Yep.
Which approach in terms of high risk reward or higher risk reward or high win rates do you think preserves consistency in the market to stop somebody hitting a spiral of negative emotions and then end up blowing the account and denying themselves of their own payouts?
I think in prop firm eras, the profile of traders and the behavior of traders have changed from back in the day when we used to trade only brokerage accounts. The fact that traders are developing the skill of getting paid and not necessarily the skill of trading. Okay.
Gamifying the prop firm industry. Okay.
And they counting if they're profitable or not profitable, depending on how much they're investing on challenges against how much they're getting paid of trading companies, and not necessarily on their P&L, because we have a lot of traders. We pay to traders who are negative on the P&L. You know what I mean? On the overall P&L, because you may pay them a payout of, let's say, 2K, and then they lose 5K or 10K. So the trader is profitable, on his payout to investment in challenges, but on his P&L, he's negative. So going back to your question, I know traders in the fibers who make the most money and who gets to the highest accounts. They're not scalping, they're holding trades for longer, and they tend to aim for larger risk rewards against win rates. So they're focusing more on large risk rewards and not so much on win rates.
With regards to your own approach, which I'm very curious about, because you've said some things that I've actually never spoke to someone. First of all, is someone on the lower time frame, M1. I think a very widespread misbelief is M1 is noise, and lower time frame you cannot find clarity. You're going to end up either taking too many losses, too many decisions, and too many emotions. Whereas for you found on M1 more clarity, more information, and a very high win rate. So completely the opposite of what people would expect.
Yeah.
What is it in M1 that you like, and how are you able to sustain a high win rate when there is more decisions to make per day?
I think that's a great question. When I'm trading, I think I'm more focused on the trade management than on the entry and exit of the trades. And I'm more focused on the trade management than on the direction of the trades. Okay, I believe I trade Forex. That's my bread and butter, Euro USD, dollar JPY. So the Forex market by essence is it's a rangy market. You don't want your currency going 10% up and down against any other currency. Okay, that's not the purpose of currencies on countries. So I will find a setup, and then I will find key levels. For me, supply and demand, that's what I trade. I find the key levels where strong movements were initiated, either to the upward or to the upside or to the downside. And around these areas, I'll try to make my entries. So the way I approach the markets is I divide my entry into different small trades. Okay, so instead of going, let's say, one lot, I go with 10 mini lots. Okay, so I divide my entry into better and more precise entry points, and then I manage all those trades as a whole setup.
Interesting.
Okay, so then I'm not so engaged into one of these trades. I'm more focusing on the whole setup. Okay, so the whole lots, the whole 10 mini lots, and not each one of those mini lots. So that gives me flexibility and that active trade management, which is also, a pivot point in my career as a trader, going from passive management into active management. That was an aha moment, because when you just passively managing your trades, you're just letting the market stats to play themselves. But if you actively manage your trades, so if you add into trades or add into wins, add into losses, you scale out of wins or scale out of losses, then you can make the whole setup a more profitable one. And that's what allows me to keep a very high win rate.
Okay, there's a lot of things I can explore here. So number one, let's say your initial point of interest, supply and demand. Before we get into the entries, how are you qualifying a supply and demand? On what time frame, what size, what criteria inside the point of interest, just so I know what are your key levels.
Okay. It's always challenging to explain all of this without showing the charts, okay? But I'll try to make it as clear as possible. So I start off the daily charts and I try to get my bias from there. I'm trying to understand if today's day has more chances to go bullish or bearish depending on the overall trend on the dailies. So that gives me a bias for the day. Then I go into the hourly time frame and I just mark the key levels, those supply and demand areas. And an ideal setup is when I have an entry either on the 5-minute chart or the 1-minute chart, on a supply or demand area from the hourly charts that aligns to the daily bias. So if I have my bias from the dailies, my levels from the hourlies, and my setup all on the same direction, either bullish or bearish, that's a winner, right? That's an A plus setup for me. If something's not aligned on direction, then I know I need to reduce my risk or reduce the lot size I'm using. So that's kind of what I'm looking in the market every day. And then my management happens on the 1-minute chart.
So when you have, let's say, a bullish daily bias, a 1-hour demand area aligned with that bias, and then you mentioned 5 and 1 minutes, are you taking that 1-hour zone and refining it on M1, or are you watching reactions in the zone?
So I refine on a 1-minute chart just to have a more precise entry point, and then I look for the setup. Could be a breakout or could be a retest, a reaction on the area, and then the retest of the 1-hour chart, and then I manage everything on the 1-minute chart.
And you mentioned you distribute your, let's say, $100,000 account, 1% risk. You're distributing $1,000 entry of risk across this demand area, refined to M1. Is there a specific strategy where at the top of the zone on a demand area, you go heavy first and then less and less, or is it the opposite? It's 5% of your entry and then more and more as you get deeper? Yeah.
So usually, if that's a good area, you tend to see a strong reaction of the area. So back in the day, I used to wait for confirmation, a pattern, whatever it is. And many times I would, the reaction is so strong that would be left out of the trade. So at some point, and if the way I approach the entry is without confirmation. So because I'm going without confirmation, I start small, and then if it goes deeper into the demand area, I add into that entry. But the overall risk, all my stop loss are below the demand area, and I'm not risking more than the, let's say, 1% risk. So I start small and then I add into it.
So I'm seeing you're weighing a few things. Number one is the cost of, let's say, price comes all the way down to the lowest point in your demand area. So this is ideal. All of your entries got triggered.
Correct.
However, the initial entry had a wider stop loss. So then your overall risk reward is lower compared to if you had one entry with the smallest stop loss compared to this distributed entries. But then on the other side, which you're balancing against is, well, what if it taps the top of the zone and flies?
Correct.
At least I have something in the market.
Correct.
Do you think this is a more worthwhile approach than just somewhere in the middle of the zone have a equilibrium of average stop loss and one position as opposed to maybe 5 things to manage?
Yeah, I think that's something you need to test to see how many times the trade would trigger you and how many times you would be left off the trade. For me, I like being active. So I'm happy going first, and then if it goes, to the middle of the area or to the bottom, to add more into it, just to be, active in the market.
A lot of traders end up frustrated bouncing from website to website, trying to figure out which prop firm is best for them. And that's why I'm proud to bring to you a partner of the show, Prop Firm Match, which is a complete, trusted and comprehensive comparison website. And with all kind of filters on their website, you can select the prop firm based on exactly what you are looking for and see their credibility based on verified reviews of actual customers, and also get insights on how long that prop firm's been around, if they are denying payouts or not. And overall, in one place, you have third-party verified information, so you can make a sound decision on where you should put your money. Because Prop Firm Match is the largest comparison website in the industry, they're able to negotiate the best prices and the best discount codes with all of their prop firms. But also with their loyalty program, you are able to collect points from your purchases to go towards even more credit and more discounts in your future prop firm purchases. So go ahead and click the link in the description to research the best prop firm for you and find the best prop firm discounts in the industry. And are you managing once all entries are now? How many entries would you do actually, out of curiosity?
There's no rule. I mean, if let's say if I have these 3 entry points, because I have the top of the area, the middle of the area, and the bottom of the area, could be 3 entries, or could be each one of these entry, let's say 5 trades or 10 trades. Just because that gives me more flexibility on managing everything.
What causes that difference between 3 and 5?
Just the amount of the lot size, the overall lot size I'm using, and how much flexibility I need. It's very discretional.
Is that based on what's in the point of interest, or is that based on how price is reacting in the zone?
It's everything, but it's something. It's something you get like naturally got used to
Instinct,
it, and it's sometimes hard to put into paper. Very it's hard to explain in words, but when you're seeing it, it's very clear to you how to approach that setup. But it would be 3 entry points or 6 or 9 or 10. It's all the same. It just
and the trade management, which you said, is actually the key, not the entry itself.
Correct.
I'm curious about this because am I correct in saying to have a high win rate, you would therefore probably have a high break-even rate of price coming back to your entry? Because if you just, let's say, put 10 entries in or 5 entries in and you have your target, a lot of the time it can also fail on you and reverse. But then if you're very actively entering, you can have a lot of unnecessary losses or avoidable losses. Does that mean you're using break-even quite a lot?
Yeah, a lot. Yeah, you would see also because you're averaging a lot of your trades. So sometimes if the zone is very if it's very wide, and from the top of the zone to the bottom of the top, there's a lot of room. Sometimes you take, once it goes back to the top of the zone and you don't see the reaction is happening, the price action is not there, the volatility is not there, I might just take all the top ones for break even, and I'm only profiting from the bottom ones, So all the first entries are at break even, because somewhat, it stays, market starts ranging within the range and it's not reacting as you wished. So it would be interesting to just pull the stats of the account to see those numbers.
Once you have price coming into your area, you're ideally looking for price to come deep into your zone and then quickly react out.
Correct.
Because you're scalping or session trading. Is there certain things that you see prior to the day or during the day that would increase your chance of this happening? Fast reactions, a lot of volatility, immediate bounce, and actually coming deeper into the zone.
Yeah, so many times it comes on how weak or strong price is pulling back towards the area. Okay, so let's say you have a strong bounce that creates the initiation, the demand level. That's the area I want to be active. So if the market comes on a compression, on a weak channel towards that demand area, there tends to be a strong reaction. But if it comes down strongly, aggressively towards that area, then it might take a while for it to accumulate and then react. So if I see this weak channel coming into the strong demand area, I'm all in because I'm expecting a strong reaction because all demand, supply and demand towards that channel has been consumed.
Yes.
So that's where I take advantage of that strong reaction.
Do you believe in liquidity manipulation, whatever the term we want to use for it, but price building a support level, a double bottom, triple bottom, and then spiking lower to allow price to come higher?
Like institutional manipulation and all of that?
Maybe not necessarily the buzzwords or the conspiracy behind it. More just interested in, is this a price action signature you monitor, trade, or utilize?
Not really. And back in the day when I just started, there wasn't this terminology. The lingo has also changed. There was no ICT. There was no ICT around, not publicly at least. So I think we're all trading the same concepts and same price action. Order blocks, all of that wasn't around. So I think we're all trading the same, just with different names or terminology. Institutional manipulation and all of that, I don't think. I've spoke to institutional traders. I don't think they're hunting our retail stops.
It's an interesting topic which I wanted to bring onto later, but it's the idea of there might be certain price action signatures, and if we see it and use it, okay. But then when we try and explain it, that's where it can get a little bit tricky.
Correct.
Because I've had people on the show that says, the market is heavily manipulated. Others that say, no, that doesn't make any sense. I don't even know where I specifically lie on the explanation. But one thing that I find curious is the retail industry right now, the millions of traders that exist, majority of them in the last few years have moved towards prop firms.
Yep.
And therefore, a lot of the activity in the market from retail traders is on prop firms now. And pretty much all or most prop firms are a B-book environment. It's a demo simulated environment. So then all of these orders that are getting manipulated, they're not in the real markets. They're in a B-book demo environment on the broker or prop firm's back end.
Correct.
So then if these orders don't exist, then they're not going to be hunted, therefore. So it does get interesting there.
But even before props, the default strategy of CFD brokers is also B-booking, not only prop firms. So, and let's not forget that it's the CFD environment, so it's just a copy of the real movements. It takes millions of dollars to move on the forex market. It takes millions of dollars to move each currency per pip, right? So it's very expensive for an institutional to move the market towards a certain area just to do the opposite. So usually what you see is trying to grab some liquidity at a certain level, and a different institution maybe pushing the market to a different activity. I know from institutional forex traders, they're not even looking at retail levels or retail accounts. Maybe smaller markets, maybe the stocks one are more easily. You have penny stocks and all of that, and you have the big hedge funds and all of that might be easier to push a stock higher. The forex market is more. It's harder for that to be happening.
At the same time, although I do agree exactly what you're saying, I do see all the time a very clear demand area on the 1 hour time frame on Euro USD. Price will come in, consolidate on the demand, come all the way to the extreme, and then during a London Open, just wick through, break the demand area, and then go bullish for the rest of the day. So you just see price wicked through the demand area, 5-10 pips, and then went in that direction you wanted. What happens here? Or what do you do in this case, in fact?
Yeah. What I do, I take the loss. If I had my stop losses, I take the loss, and if I see the strong reaction, then I try to rejoin. Okay. Because many times you're expecting that whipsaw to happen, but that one time that the whipsaw doesn't come and it follows through, I've been there. I've felt the pain of losing thousands of dollars, not prop firm capital, bias, personal capital or investors' capital, and I'm not going that way again. So I set my stop losses, and if I get stopped out and then I have the opportunity to rejoin, I will do that instead of hoping or waiting for the whipsaw, to happen.
So all of your stop losses are at the bottom of the demand area.
Correct.
So even if you see M1 breakout, you could put the stop loss at the bottom of the breakout zone, at the bottom of the consolidation, but you still choose to have it in the demand area. Correct. Everything at the demand.
Correct.
So therefore, your risk reward, the lower you get into the demand area, the last entries have a better risk reward.
Correct.
So then you mentioned, because you have a flexible risk reward profile, does that mean you have an equal exit for all positions, or do you scale out in a similar fashion?
No. So my exit, both stop losses and take profits tend to be the same for all the trades.
Okay.
And that's why my risk reward ratio is break even or even negative. But the fact that I don't scale out on my wins is just because that, I'm sure you've been there, Waqar. You want to ride the trade, you bring your stop losses to break even, and then it reverses and takes you out for break even trades. And I think that's what most traders are doing, and most traders are break even or losing money. So I just prefer to bank profits, and if I need to rejoin then I'll rejoin. But I'm taking full losses, full wins and partial losses. You know, so if I see trades going sideways, not going in that direction I want, I might be taking partial. You know, I'd be scaling out of the losing position.
That's interesting.
Okay,
Yeah.
so I'll be taking partial losses, but I'll be taking full wins.
Your average zone refined to M1, the demand area, on Euro USD, I'm guessing like 15, 20 pips is the depth of the zone.
On the Euro USD
Okay.
could be 20.
So therefore, because you're doing almost a 1-to-1 risk reward, that means after prices bounce 20 pips out of the zone, you're out of the market.
Correct.
Meaning to say, if prices, let's say Asia range is consolidated right above your demand area, London Open happens and your USD comes into your demand, you're laddering your entries. By the end of London session, you're probably out. Like you're not holding a trade for hours or days.
Correct.
It's maybe even 30 minutes, 2 hours.
Correct.
It's around this duration.
Correct.
This is exactly what I'm doing, which is the reason why I'm talking through this. Because I'm a big believer in demand. Sure, it's a very powerful concept. And if you align it with the daily time frame, sure. But then there's also a lot of negatives with swing trading that I found, because I used to be swing trading too. One of them was if I was entering on an M1 time frame and I was able to have a sharp stop loss, but then my exit was on the daily time frame, I had the potential to have a huge risk reward.
Absolutely.
Which seems like a dream, but in reality, in execution, you realize you're up 1 to 10 risk reward, let's say, and you haven't taken a partial. So if your target is 1 to 15, that means you're willing to risk 10% of unrealized gain to then gain another 5%. It's a negative risk reward to hold. So then I went to the opposite end, just like you, and I thought, why not just take an exit on the average session movement? If London session on USD average is 25 pips, let me look to exit something around 25 pips, because on the best day, on the worst day, this is the average movement, and then it retraces, comes back to break even. I can get in again, or whatever the case may be. But in this case, partial. At the average London movement, I will take a partial around the 25 pip mark.
Okay.
Because then the average daily range might be 50, 60. So I can potentially capture the rest.
Yeah.
Do you consider the average daily range alongside your session range?
No, not at all. I'm always looking at levels. So I'm not looking at ATRs. I'm not looking at average range. I'm not looking at that. I'm placing both my stop losses and my take profits are at key levels, because I know the market will fluctuate very easily from key level to key level.
Yes.
I don't want to ask the market to break those key levels in order to get to my targets, which is what happens to a lot of retail traders. Their take profit just above the key level, and they're so close, and the market reverses, and they don't understand why. I want my TP to be just below the next key level
To be safe.
Yeah, to be safe. And then I see there's strong momentum. I'll rejoin. That's for me a new opportunity to rejoin the trade. That's a new setup. But I take all my profits at the key level.
And those counter levels in a demand scenario, you're looking to buy, you got in, and now you're thinking about your exit. Is this something you're already predefined based on counter supply zones that we're building into that demand? Or is it Asia high, session high, previous day high?
No, usually my exits are from the supply areas on the 5-minute chart.
That allowed you to come into the demand. Okay. And it's just a hard TP level. You're not looking for rejection or anything.
Nothing.
Okay.
Just hard.
And it's not a scale out like your entry. It's one fixed level.
Yeah.
Very, very interesting approach. I don't think I've seen someone that is doing it like this, but it does make a lot of sense. Now, the next thing I want to transition towards is the traders you mentioned on the back end that you see. You have data of probably hundreds of thousands of traders, and you're mentioning that the most success is found with people holding trades for a little bit longer.
Correct.
And going for a positive risk reward.
Correct.
Now, this is opposite to your own beliefs and what you are doing in reality. Why do you think this difference lies between your own approach that is working for you and many traders that are profitable on your platform? What is the difference here?
I think taking trading skill to the level that you need to be a profitable long-term scalper, for the long run, it takes a lot of time, takes a lot of skill, and a lot of work. And most of the traders that are coming to the prop industry, they're not yet in that stage. And as I mentioned, it requires more management and more patience and more discipline and more screen time. So I think holding that for months in order to scale your accounts and to get into the bigger payouts and all of that, most of the traders are not there yet. So most of the traders I see successfully making payouts and getting into larger accounts are swing traders, which just requires a good signal, a good entry, and then letting the trade go in your favor.
You mentioned earlier that people maybe are break-even traders. If they were to do one account, long-term track record, they might be losing, they might be break-even. But in a specific approach with prop firms, you just simply have the ratio of your evaluation fee payouts, and you might blow an account, you might be down 10%, but it only costs you a few $100s.
Correct.
But your payouts might be thousands of dollars.
Correct.
So in your real P&L in your pocket, you're up, but your equity curve is all over the place.
Correct.
So I completely understand this game. And would you speculate that the traders that you see success in on your books that are getting the large payouts are the ones that are more skilled and therefore better swing traders that you find, or is people that are just better at the game?
I think they're better at the game. If I share with you a little bit of the risk management behind
Sure.
the company, I think that would give a lot of clarity on what happens behind the scene. As I mentioned, back in the day when there was a lot of companies and a lot of competition, the profit split was also smaller with the traders, and it was very easy to go a book with them to send all the trades to the market, and then 50-50 with the traders, and the maximum loss was smaller than today. So the risk management was simpler. Let's go that way.
Interesting. Okay. Just before you get into this, 'cause I'm very curious. Yeah. I thought, and a lot of people watching do think that, well, if you have, let's say 90% of traders are losing, then you just trade the opposites of what they're doing, and then you have 90% win rates. Yeah. Is this, and I'm just speaking to many, they're like, this is not a reality that you can actually execute upon. Why is that?
First, because the costs are very, very high. When you're sending trades to the market,
in terms of volume of orders,
the LPs charge commissions and fees per volume and spreads. So usually on a lot of props, us included, we sponsor the spreads, for example. Okay, the spread in the market might be different, so that's fine as long as we take it into the business model. We're doing good. But if you want to take all your trades and do the opposite, so the trader is paying a commission, you are paying another commission. You pay twice commission. You pay twice spread. You paid the LP fee, and all those costs make just unprofitable. The whole setup unprofitable. So just taking everything and going against or doing the opposite of your trades, it doesn't work.
Interesting.
Yeah.
So previously, the A-book model was working.
Yeah.
You mentioned. How was it working back then? And now you're going on to say how it changed, I guess. So what was working back then for the props to be able to A-book a lot of them?
So the programs used to be more expensive, and the maximum drawdown used to be smaller.
Okay, so different economics actually.
The economics were different. And the profit split was 50%. So if a trader used to lose money, most of the drawdown was covered by the fee.
I see.
But when they money, so we used to split the profit, 50-50. So we did good. And also, there's the economics were different. With competition, with when new companies came into the market and the prices went down and the profit split increased in traders' favor, that brought a new challenge to the risk management of the companies, which is a good challenge for us, that made us, think out of the box and creatively.
Okay.
And we thought, doing PPOC would be the right call. And turns out if a company is only PPOCing, the trades will also not be profitable in the long run because you're paying the payouts, but when a trader is not losing, you're saving that money, but you're not making any profit. But when the trader is making money, you're not making any money with him, but still you need to pay him. So you're relying only on the fees.
So if a prop firm is relying only on the evaluation fees as their only revenue source, and obviously their biggest expense will be the payouts and their team and so forth. If they were to do this in 2025, it wouldn't be a profitable model.
Yeah, it's not sustainable.
Interesting.
I mean, you may have short-term success, as the hype goes and a lot of people come, but eventually you will face those payouts and it's not sustainable. You need to.
So in pursuit of sustainability, longevity, to be able to afford with ease the payouts, what did you have to do to adapt?
Without going into too much detail, but you need to profile and you need to understand, today it is becoming a bit easier with AI and machine learning, but to as quick as possible to understand if a trader is going to make for a payout or not, just based on stats. And based on that, you decide if you A book, B book, C book, go against.
And this is on what criteria? Just their behavior in the evaluations?
Yeah.
Okay. And are you looking into other things like age, demographic, a questionnaire maybe? Is just only on performance?
Only on performance.
And just out of curiosity, swing, scalp, lower time frame, big stop loss, short news trading, all of these variables that you see, which ones have you found to be more consistent in terms of any sort of profit?
With all the machine learning, everything is changing also for us, because you let the models work for you. So you don't even have all the details of what the model is doing in order to get into
you get results actually.
Yeah, you get the results. Before that, let's say 1 year ago, 2 years ago, we still have them, the pool accounts. And then if you have the right profile, again, with algorithms and everything, you have the profile of the traders and you have the overall book. You're not looking at an individual trader, but you have the book and you manage, the whole portfolio. So when you see the portfolios are performing good, you can leverage those. If they're performing, wrongly, then you can go against the portfolio and all of that.
For the last 2 years, a proud sponsor of the show is a top-ranked leading prop firm, Alpha Capital. And for the years that I've been working with them and the thousands and thousands of viewers, you guys, that have been working with them through the discount codes of Titans of Tomorrow, it's clear for me to see why they are a top-ranked prop firm in the industry. They have also reached a monumental milestone of $100 million in payouts. And with the multiple step plans and the multiple package types they have, there's going to be an option catered specifically for what you're looking for. So you can buy an evaluation account catered to your needs at the most competitive prices, and with our discount code TOT for Titans of Tomorrow, you're able to get the most unbeatable, unmatched prices in the industry with a leading trusted prop firm. And with that being said, let's get back to the episode. When the machine learning has identified a profitable trader that you are in this hybrid approach, A book and B booking, with the profiles you are A booking, identified by AI. Now you've got conviction in this because of the data that you have, and now you're A booking these clients. I feel like this kind of approach is probably adopted by many with brokers, with different risk teams. But the difference with broker, I want to draw this parallel, is people are trading their own money. So if someone has deposited $5,000, it's their hard-earned money. So the likelihood of consistent behavior is probably higher. Whereas with prop firms, you always have this in the back of your mind. If I paid 500, I've got a 500 payout, I'm break even. It's not my money. So you might be consistent for 1 week, 2 weeks, and then one day you wake up and you think, my max daily loss is 3,000. Why not? And then you throw it. And this is unpredictable. This is just human greed or random behavior that the machine learning no one can identify prior. But then this becomes a big issue because if you A-book them and then they have consistent behavior and then one day they change their behavior, it can lead to a damaging amount of loss. How do you navigate this to still have sustainability?
At the end, if it's a matter of large numbers, we don't analyze any specific trader, individually. It's we look at things, more from a broader perspective as a whole portfolio. So we might have a trader in a profile. We don't know the trader. We just know his trades. We're doing something with his trades, and if he changed the behavior, we might suffer from it, or we might benefit from it. So we don't know, but we don't look at traders individually.
Sure.
We just have
and in general, machine learning, it's a word I hear around, but truly I don't fully understand what it is or how it works. If you can shed some light upon what it means to be using machine learning for your risk management.
I don't think we're very, the gap between us is not very large. There's the AI team and the data team working on that. Yes. You see the models and you just see lines and lines of code just running, and you get the results from those from the codes, and then you try to build models around what the the codes are telling
and
you.
firms that are, let's say, any of the top 10 firms, would you argue they are all utilizing similar strategies? Or do you share information? Do you share and collaborate? Or is each firm has their own way?
Yeah, each firm has its own way. I don't know what's the risk management guidelines of other firms. I trust, they do
The reason I
whatever
asked that is
good for
because
them.
I spoke to another prop firm owner not too long ago in New York, and he was mentioning this gamification side of it and how it's becoming an issue, because when individuals are trading with pure intentions, that's what it's there for, and that's predictable behavior, and you can adapt your risk profiles for this. Correct. But when you have organized groups that are just here to exploit the system, just like you have organized crime, you have organized people going to the casino and gaming the system. At least in a casino, you can catch the card counters and the guys with the glasses on, whatever strategies they use. Because everything is inside one room. It's inside the casino.
Correct.
But in the prop space, they might be buying on your prop, selling on another one, and playing the numbers game. But if you were all to share information, then you could catch the cheaters. But now if you're all individual components, you cannot find these cheaters. So, and I know it's on a rise. These cheaters are on a rise. What can you do to mitigate this? Or is it just cost of business? It is what it is.
It's a little bit of everything. At the Fivers, I'll give you a long answer for this, but at the Fivers, we're always aiming to get to the authentic traders. Okay, we work very, very hard to bring the community and support for traders, and I like to believe that more genuine and authentic traders come to us. We have we do have this phenomenon of organized groups. We know how to identify them, and usually they don't get into the funded accounts. Okay, we know how to spot them. We know how to identify them. We have a risk team and a dealing team and everything in place in order to spot them. Those who do get to the funded stages, as long as we understand what are they doing, we're fine with it, because we know what to do with their trading. The problem comes when, as you said, okay, he's doing something consistently, and then one morning he wakes up and he does something very different. So we do fight this phenomena of gamers or organized group and all of that. That's our, sadly, our large, a large part of our operation goes towards that. And I think we're doing good on, spotting them and stopping them before they go into the funded stages.
So because your firm is one of the first firms, 2016, when it was initially founded, there was only maybe FTMO and maybe a couple others, I don't know.
Correct.
But in your time, especially around 2020 COVID, that's when like every mother and a dog and everyone had a prop firm. And the rise of influencer props. I want to understand, is there anything for us to learn or observe from your experience of, I want to call them real prop firms versus influencer-owned prop firms, where you're sitting with a team and a risk team and you have a full infrastructure, whereas these guys have just some followers online and maybe a tech provider partner. What difference have you seen in longevity, infrastructure, and general business practices?
I think for traders, if I was a trader just coming into the industry, I would feel overwhelmed of the amount of offers out there, of the choice, amount of prop firms out there, the amount of content, the amount of everything. And it's very difficult to choose which prop firm to work with. I think traders need to get very informed on which prop firms to work with. I don't know many of the prop firm managers or founders, and I want to believe they come with the right intentions into the game, into the industry, because at the end of the day, what we're trying to accomplish here is what we talk about at the beginning of the conversation. We want to help traders overcome the big challenges of being a trader, which is lack of capital, psychology, pressure, lack of community, lack of information, lack of education, all of that. So we work very, very hard with that. So I think if as a trader, you see a company with the right values, which is investing in you as a trader, they might have aligned interest with you as a trader. the traders back in the day, I don't see them a lot today, but back in the day before the technology providers came, there was a lot of attempts to just do a lot of marketing around the trades, and I think kind of damaged the reputation of a lot of the industry as a whole. They brought prices down. They make everything more gamey, and the risk management challenges around it. But if you go to larger companies, well-known, high reputation, I think you're in good hands.
Yeah, the reason I draw the comparison is because as quick as these influencer ones came, they very quickly disappeared too. And with that, a lot of upset customers and traders. When we are to compare just overall infrastructure, I can see that most people, I want to say, come in with good intentions. There are the bad actors like anywhere, but majority, even the ones that failed their prop firm, they came in with good intentions, but it's just a hard business model, or it's harder than they thought before they started, which is a reality I'm sure you're aware of, because you've had every high and low in the industry, because you've been navigating for many years, almost a decade now, actually. Next year will be 10 years.
10 years.
So with that much time in the game, what have you seen as certain things that you had to do to see how others are? It's a price war to the bottom. It's a gamey, the better the conditions of the trader. But in the end, it's harder to be a sustainable business model. And the reason I say this is because maybe 20 or 30% of the guests I've had on the show, they speak bad on prop firms. And I'm a big fan of prop firms. I think they're a great tool. And yes, there's denied payouts. Yes, there's people that got scammed, rug pulled. There is these bad things that happened. I'm not denying that. But at the same time, there is people that are 18 years old, living at home, 1 year into their trading, made $30,000, life-changing money. So there is wins and there is losses in this space. But overall, I think it's a net positive. But when I speak to these guys that are like, prop firms, no, don't do it, it's because they're looking at the pocket of the bad ones. But then if you look at the pockets of the good ones, the top 5 that have been around for many years, it is a different case. For someone that is watching or follows influencers that says, prop firms are bad, avoid them, just focus on your own money like the people used to do, what would you say to them? Of like, why is prop firm still worthwhile?
Yeah, I remember a lot of videos done around the fivers, why you shouldn't trade with the fivers. It's better for you to trade your own capital. We used to offer low leverage, and we still promote low leverage than high leverage. It's amazing to see how low leverage traders live longer than high leverage traders. Okay. That's a different conversation. But they used to say, okay, take your money, take it into an offshore broker, trade with 1 to 500 leverage, you will make more money than trading with the fivers with low leverage. Okay, that was kind of the point. Okay. I think trading with a prop firm like the fivers or any of the big ones will give you we solve one of the large pains of traders, which I remember myself, which is that, okay, do I withdraw profit or do I grow my account? Okay, because you have the leverage, you have the account, you grow your account by 10%, and now what? Okay, what you do with that? You keep scaling it, you withdraw your profits, and then you're back to your initial balance. So prop firms, they solve this. At the fivers, every time you reach a milestone, we scale up your account. So let's say you start with a 10K account, you make 10%, we scale your account to 15,000, 15K account, regardless of you withdrawing your profit. So you can withdraw profits and scale your account, which is not something you can do with your own account, right? So even if it's going to take longer because you have reduced leverage than the 1 to 500 or 1,000 you can get on an offshore broker, it's worth, that scale of accounts and withdrawing, that's something you cannot do on your own capital. So that would be my argument for that.
The next one I want to get into is kind of, this might be a tough question, but I'll ask it because a lot of people will want to know, is just the overall conflict of interest side of things. Not especially your firm. I think every firm has this dilemma where I think back in 2016, people were not so aware. In 2025, I think every prop trader knows that the evaluations pay for other people's payouts. It's a business model. My stance is it's absolutely fine. I want the prop firms to thrive as a business because then they can afford the payouts. And you don't want prop firms struggling because that's when the denied payouts and the problems come. So if the prop firm is winning, the winning traders are winning, everyone's happy. And the people that are blowing money on these valuations, they need to reconsider their choices. If you haven't found consistency, don't blow your money. That's individual responsibility. But at the same time, a lot of firms, they will now do predatory practices or slippage or other things that are only there to cause traders to struggle, and that becomes the benefits for the firm, but then to the detriment of the trader, because there is a underlying conflict of interest. I can look in this and say, well, brokers do the same, where the winners are paid out by the losers, in the sense of your deposits pay the payouts on brokers. Even when you zoom out and look at the whole market, you can say, well, there's no money created in the market. It goes from winners to losers. So the zero-sum prop firms, zero-sum brokers, zero-sum markets, I understand that's how the world operates. But the predatory practices and the conflict of interest brings an ethical conversation here. So I wanted to hear your thoughts on this.
Yeah, I think for everyone who've traded with the fivers, we're always trying to give traders the best trading conditions. I told you, we sometimes we sponsor the spreads. You will get it. You'll trade with us major pairs with zero spreads. That's not real market conditions, right? That we get from our LPs a certain spread, and we mark up down, okay? Because we want for traders to have a better position. So even if when we're going out to the market on real accounts, we might be losing on the spreads. We absorb that loss, but the macroeconomics, they're still in place. So we never go, I don't think we have a certain thing that goes against our traders. Okay, our interest with the traders are aligned. We don't have any conflict with interest. I told you we don't look at traders individually. So as long as it's not something that we cannot replicate in the market, so there might come traders with EAs that we cannot really make money on the market with those, or emulators, or rollover scalpers, or spread scalpers, or we cannot make money with that. But as long as the traders are authentic, speculative traders, and we know how to manage that in the market, whatever risk management we need to apply, I think our interests with them are aligned. We don't have any predatory practice. We don't have a slippage and all of that. We don't need any of that.
The next topic is more future orientated and is surrounding this word regulation. Now, I think it's a very misunderstood term, and it has a lot of depth to it, where it's what jurisdiction, there's a lot of things that come here. And even the broker industry, which is much more mature, you have the Seychelles and the offshore brokerages, but then you have the regulated ones with less leverage and harder conditions. So people still pick the unregulated option, despite regulated options being there. But I want to draw a parallel, because this is from your time. The MyForexFunds, the rise and fall, let's say. I actually didn't keep in touch with what happened to that case in the end. In the beginning, I did. But just generally how you viewed that situation, how you learned from it to put maybe measures in place, and just your general stance on what do you think the industry is going to happen in the next 5 to 10 years with the regulation?
Yeah, I like this topic because we are in conversations with the regulators. We have actively approached them and asked them and request from them a regulation to the industry, because I think it's something necessary. It's something that traders and companies will benefit from, a regulation in place.
Which jurisdictions or which regulator?
SISEC, for example.
Okay.
We've met them. We're in email communication with them. From what I understand from regulators, they are very focused on other topics, crypto and other things they need
bigger markets.
Yeah, bigger markets they still need to regulate. They don't fully understand the nuances of the prop firm industry.
Interesting.
And I think once they bring a regulation, would be similar to a bank regulation. I'll go into detail with this.
Okay.
When we asked them before that, when we requested from them regulation, they were not willing to regulate us just because there's no retail capital in the game. So what SISEC does and the regulators, the forex regulators do is to protect the traders, the retail traders.
So they don't see this as trading activity because there's no deposit into an
Correct.
account. And how do they view, therefore, the evaluation fee, which could be seen as a deposit if there is instant funding, maybe? I don't know.
They're not seeing it. They don't see it that way. So when you see, SciSec, they're fine with brokers doing a B-book, for example, as long as they pay. So what they request from brokers is not bad practices, no slippage, no all of that, and to have a certain amount of money, in their accounts in place all the time to be liquid and all of that. And I think for the prop firms, once they decide to regulate, they'll request something similar to not bad practices, and maybe limiting the leverage you can offer, no more 1 to 100. Maybe you need to go down to 1 to 30, something like that, and to have money in their accounts when there's disputes, when there's things to solve. But we haven't heard back from them saying, okay, we're going to regulate this. So
with these things in mind, what was the issue from a regulatory perspective with MFF, MyForexFunds?
From my understanding, what I remember is that MFF, they used to, they also ran a unregulated broker.
Okay.
And that's what triggered the whole case to initiate. I think I didn't follow, same as you, I didn't follow what happened afterwards, but I think afterwards, everything that was not related to the unregulated broker was dismissed. And I don't think they go into the prop firm side of MFF.
Okay. Yeah, from what I gathered, it was kind of not looking into the tech or the industry. It was more looking into a few things that they're doing that could be seen as fraud, maybe.
Yeah.
I don't know. Or bad practices as an issue. Moving into, let's say you're saying the regulators move slow and they have bigger priorities like crypto, which are much larger markets. Mm-hmm. Therefore, what timeline would you imagine any change to happen in this space?
I hope it happened today. Okay. We offer to them to be part of their process of creating regulation if they need to understand the industry from the inside, to help them understand the industry from the inside in order to set the right regulation, who's not going to destroy the industry, but to help it grow healthier. We haven't heard back from them. They haven't thrown any light of
interesting.
Okay, are we going to do this? I have no clue, but I hope it happens soon.
With regards to other large prop firms, I want to speak about the large ones because I see them as they've stood the test of time. They're more reliable. They have better practices, infrastructure, and so forth. The ones that are, let's say, top 10, I see a lot of them. They post like, we did 50 million in payouts, 100 million in payouts, and just from what you see behind the scenes, is this something realistic? Because I think anyone can claim anything, but there is no way to prove it because it's not any. Some of them will be through crypto. And I spoke to Justin from FBFX. He said, on a first glance, it makes sense. But then when you look deeper, they can just move money through a wallet and bounce it to their own accounts. And it looks like payouts, but it's just staying in-house just to inflate numbers. So there's going to be tricks and marketing and all of this. But what are like realistic numbers of any big prop firm?
I think within the top 10, there's a large scale and a large difference in sizes. I think number 10 is very, very far from number 1.
Okay.
I believe so. There's certainly, I can tell you from the fibers, we do get into the millions of payouts every month. So if there's someone, the largest, the large company saying, okay, we pay 10 million, 20 million, 30 million a year, it's credible. Wow. If you hear, small companies, even the, number 10 or 9 or below that claiming the same, I don't think, I have no way to prove that, but I don't think those are the numbers. I do know there's some practices of moving the money around to try to make inflate the numbers. But yeah, I don't think those are.
I've also come across two things lately in the last year, which is one is people coming out and saying our funds are real funds, completely A-book environments, and it's not like it's to say your 100K account is $100,000 real capital, and all you have to go through is phase 1, phase 2. When I see this, it seems pretty like, okay, but majority of traders lose. So why would you give a trader you just assessed for maybe 3 weeks, give them $100,000, and yes, it's only 10% risk, so it's only $10,000 of exposure, but they paid 500. So you have an issue here, and you A-book everyone. Is this something that causes alarm bells, or it's realistic?
It doesn't work that way. At least not in the fibers, because if I have traders with 100K account, doesn't mean I need in my pool account to have 100,000 time each one of the traders train that. I only need to have the enough capital there with the leverage to allow them to trade whatever they need to be able to trade.
The margin, yes.
Okay. Yeah. Is that clear enough? So, and our pool accounts, they have larger leverage than the leverage we're giving them. So they might have 1 to 30, 1 to 100 leverage on their account, and they have, let's say, a $10,000 drawdown to manage. Our pool accounts have larger level. Those are institutional accounts, and they have larger leverage. So we don't have to have. Those are large accounts, right? But it's not 100,000 times each trader, each. It's just
because it becomes hundreds of millions very quick.
Correct.
It's not realistic.
It's not the case. It's only enough to allow them to trade whatever they're supposed to be able to trade.
I finally have a special offer to share with all of you from the US or my futures traders, which is over 20% of the listeners of the show. And that is Alpha Futures, a leading futures prop firm that is working with Tradeoff and NinjaTrader that are compliant with CME regulations. With the largest end of day balance drawdown in the industry, a 90% profit split and same day payout. And with the most competitive pricing in the industry, with accounts starting at just $79. On top of that, just by being a viewer of the show, you get up to 40% off all evaluations. So why not get started with an evaluation right away, trading $50,000, $100,000, and you already know the power of prop firms and larger capital. So go ahead and use the link in the description or code TOT for the best prices in the industry, plus the best discounts in the industry to make this a home run offer if you are a futures trader. Yeah, I saw it more as buzzwords. People like this idea of like real funds, and I think some firms ran with it. The other one that I've seen the rise of is instant funding.
Yeah.
Now, I think it's also a beautiful tool as well, if it's done in a certain way, because a trader who is passing phase 1, phase 2, they made 15% potentially around this area, but they didn't get paid for it, and then they have to go and get paid.
Correct.
So you can call it a valuation. I think that's a very understood model. But some people might want to pay to skip the process and get instant funding. But then you can also enter into dangerous territory in terms of risk and the back end. I want to hear if you have any ideas on how that would work. And second is, would this cause any regulatory issues? Because a few prop firms I spoke to, they said we would want to get into the instant funding space because it's an attractive offer, but it looks too close to a deposit in a broker to have access to larger leverage, and you just worded a difference, and that triggers into a broker space.
Correct. So that's the key. If you want to offer instant funding, you need to make sure that the cost of the account covers most of the drawdown you're willing to offer, and then it's similar to our very first model, which we used to do 50% split with the traders, the one-step program. But that, on regulators' perspective, would be considered a deposit. And just to avoid going that direction, we haven't implemented that model. But I think our main concern would be that, like, to be perceived as a deposit on a brokerage account also. Yes. But I think the risk is manageable as long as the payment for the account covers the cost.
And probably lower leverage as well.
Correct.
To be sustainable. Moving into, just say, the last 10 years or 9 years in the prop space has been so volatile, so many changes in conditions, prices, participants, even the traders' behavior. And I think a very pivotal year was the year the MT4 crisis kind of happened. What do you see the space going in the next few years in terms of, will you see more people coming, or will you see the price war reaching a floor now and then only the biggest surviving? How do you see the space navigating?
Yeah, I've seen the last years the industry kind of self-regulating itself. I think...
What do you mean by that?
By traders not falling into marketing.
The consumer is smarter now.
Yeah, yes. The consumer is smarter. They understand that if a company is offering 50% discounts every time, there's something fishy here, that is not sustainable. So the traders are smarter consumers today. And I think companies the same, companies, even large companies that they started with very low prices, you've seen them increasing prices just coming to sustainable levels. So I think companies are aware of what's the bottom of the price they can offer. Traders are not, are willing to pay higher to make sure they're going to get paid. They're getting into a reputable company and not going to a company that just started, even if it's cheaper. So I think that balance within, traders' understanding of the industry and companies' understanding of the industry and the risk management behind, it's kind of setting the levels of what's sustainable. I don't know how many more companies can come and make it and stay sustainable, but I think in a couple of years we're gonna see this 50 companies or 20 companies that make it and that lead the industry. And I'm sure the fibers will be there.
I gather, and you can correct me if I'm wrong, but the advantage the biggest firms have is the new influencer ones, the backing financially they have is whatever they have in their pockets.
Correct.
Or that they're willing to use. So if you have a drop in revenue, you can still withhold payouts. But I imagine the top 5 firms, they're sitting on millions of dollars or months and months worth of payouts just in reserves. So even if you have a bad month or an issue, like happened with the MT4 situation, it's not a crisis. You are prepared. Would that be something true?
It's not only that, it's the fact that you have your own team, you have the data, you can, you spoke with you know the industry, so there's technology providers. So it's very easy for someone to buy this technology and start your company. But then you don't have the flexibility or the ways to develop what you need in order to manage risk. So in our case, on large companies that have their own technology, you can develop, like we mentioned, the machine learning systems, the model, the risk management behind, the compliance behind, everything behind. And all that operation helps you not rely that strongly on your savings or whatever it is. You know how to manage and how to manage the risk management behind changes. So I think it's something that's not doable. It's a lot of effort and a lot of investment in servers and AI technology and the languages, and it's very expensive. So having that sources and that technology in-house allows you to do that and not relying on someone else's technology.
The ending portion of the conversation I wanna bring into it just makes me laugh bringing it up, but you mentioned earlier ICT. Now the reason I want to bring this up to yourself is you've seen the trading activity of many, and I'm sure many of those are ICT SMC traders. I think in your time in the space you've seen an industry with no SMC and then everyone's doing SMC. And although there is merit to the strategy and the approach, more importantly, there is certain figures in the industry that have made huge success with these strategies. So then you see the headline of $1 million payouts, and I've spoken to a lot of these guys, and they are amazing guys. But I also know law of large numbers and anomalies do not define the rule. So I want to hear your thoughts on the behaviors of these kind of traders compared to the certain traders you've mentioned that are consistently getting payouts. A lot of the viewers are going to be in this category of SMC, ICT traders. Are they a carrot on a stick, kind of chasing a high, or is this something that can really work on mass scale?
To be honest, I don't know who in the fibers is trading SMC or ICT. I don't know what they're doing. Okay, we just look at the trades and we just look at the book, and we're not so concerned if they doing certain strategy or another strategy. So it's hard for me to spot. Okay, if SMC traders are performing better than other traders, because I don't know what they're doing. I don't know if they're doing that strategy or not. We just see the positions. We see if we can match it with something.
Sure. What about general behavior? So you mentioned trade duration is more favorable for the profitable traders. Is a longer hold time. What other patterns would you say in terms of trade frequency, risk strategies, high risk, low risk? You could also have stop loss size in average. Asset classes chosen, trade many things, just trade 2 things. What other behaviors have you seen in the profitable?
That's a great question, and it's that's very clear to spot and to see and to explain, because we have a very powerful program in the Fibers, a scaling plan. Okay, every time you hit a milestone, we scale up your account, and we have one of those scaling programs which we double your account each time. So which is very powerful. You know, traders who commit to long term and hit 10% a couple of times, they're very quickly managing $300K, $500K, $800K, $1 million. And there's only a few. It's like a pyramid, right? A lot of traders are in the base of that, and a very few and fewer advance to those higher levels of funding. And that's where you see the patterns of those traders. And you can see most of them use stop losses, and they deal with those losses. Most of them are not scalping, as we mentioned. They're trading fewer trades and letting their trades run. And if you interview them, because we tend to interview the successful traders, the same kind of conversation we had at the beginning, when you understand the in and outs and the small print of the strategy, that level of understanding, you can have them with them, you know. So you understand they're sophisticated traders. They know their strategy. They know when to perform, when not to trade, and they're trading low leverage. So even if they have that access to 1 to 100 leverage, surprisingly, they're not even close to that. Okay, they're trading 1 to 10, 1 to 20 leverage. So just another side story. And I'll come back to this. There's some traders which just when they end the evaluation stages, we're not sure what to do with them. Okay, and we ask them for a couple of weeks to trade with lower leverage, and then we release them. But just to understand their behavior, we ask them to perform with lower leverage. So we adjust their leverage to a smaller leverage, and those traders live longer, make more money, make more payouts. So those higher level traders are also trading with low leverage because they understand that they need to live another day to trade.
Yes.
So they don't let those losses to be more than 1%, more than 2%, let's say. And in order to risk that 1%, you don't need that much leverage, right? You just need 1 to 10, 1 to 15, 1 to 20 probably. That's all you need.
With these interviews of the successful traders that you have you noticed any personality, psychology, beliefs in the markets that have showcased this is a common denominator amongst the successful?
I think it's just the approach to risk management, the respect on risk management, and the mastering of what they're doing. Okay, they long ago stopped chasing strategies, because that's the strategy hopping is a very when you're just starting, you go from strategy to strategy. At some point, these traders and myself, you just stop, you stick to something that makes sense to you, and you tune it into your situation and you master it. So these traders master one thing, one strategy, and that's what makes them successful.
And when you look at the data or behavior of the thousands of losing traders, is there something that stands out and says, okay, if traders are just to correct this one thing, this would eliminate a lot of losses? Is there anything that jumps out like this?
Leverage. When we, I think it was 2021, we used to have an account with low leverage, like 1 to 6. And, it's perceived as very low leverage. And there was this demand for higher leverage. We want higher leverage. And we opened the same account with the same program with, I think it was 1 to 30 or 1 to 50 leverage. And a lot of people went there. And you could see traders in the 1 to 6 leverage performing better than the 1 to 30 leverage. So
why
traders,
do you think that is? Is just adjusting to the larger numbers?
Because I think traders, and I've been there, when you take the loss, you take the full loss. And if you take in high leverage, you take a large loss. But when you have a win run in your favor, they tend to cut it earlier.
That's true.
So they take in very large losses, and the leverage allows you to take very large losses. So if you stick into low leverage and you take in small losses, you live longer in order to to recover, to get out of the drawdown, and to make profitable the next session or the next day. And surprisingly, we saw these traders from the high risk program they really wanted going back into the low risk program and performing better there. So today, when I see a lot of traders not performing well or losing accounts, it's just because they train very, very heavily, or they train a lot. They're like they're doing they over leveraging the accounts.
So have you found any pattern of the people that tend to lose quickly, or like people that get through phase 1, phase 2, but you just know that these are likely to not even get a payout, to blow the funded accounts? Is there any behaviors there, or any patterns? Like, do people tend to go more towards the minus 10% and overall lose the account? Or is it the max daily loss? They just have a bad moment and mess it up in one day. Is there anything as such?
There's a funny pattern you can see when traders are going into drawdown and they just take a very large trade. And
risk-wise?
Risk-wise.
Oh, okay.
And then that will take them or to the daily loss or maximum loss, or will take them out of the account. And you see the same when they're getting closer to the take profit. So when they're going into profit and they're, let's say, 2% far from take profit, they also take a large trades.
And they want it quick.
Yeah, and that's a mistake, because you just need 2% more and they risk a lot and they go down. So when traders get consistent with something, with the lot size, with the risk they take, you see them performing better and eventually, getting payouts.
Makes sense.
When you see traders increasing leverage, reducing leverage, increasing leverage, reducing leverage, they don't get that skill of consistency, and then it's hard to tell if they're going to make a payout or they're going to lose it, right?
For me, that screams like dopamine chasing, gamblers kind of approach, as opposed to a systematic one. I want to end by just giving you the opportunity to either something that I didn't ask that I should have asked, or something that you maybe wanted to share coming onto the show today.
I think if we look at the fivers and if we look at the industry, I think prop firms have a responsibility to creating better traders, okay? And if the interest of the companies is to have, the 5% of traders that make it constantly to and profitable to manage large amount of sizes, this should be in the interest of the companies also to help traders become better. And I think that's something we see companies doing, and it's something we pursue a lot. And creating this whole ecosystem of services, of education, of community, of risk management resources, in order to help traders develop the skill of trading and risk management. And I think if more companies do the same, we'll eventually create better traders, and that will help also companies to deal with risk management and traders' behavior. So that's a message and the flag we've been, carrying for years, and that's our, core principles, our core values of creating for the traders the whole ecosystem, and not only having this relationship of customer and company, but as a partner and as a trader, and as a, this common interest relationship with the traders and the companies.
Man, a beautiful episode. I really enjoyed it. I think we covered so many topics, and it was a lot of fun. So I just want to say thank you. Thank you for coming. Thank you for flying in.
Thanks for the invitation.
Boom. There we go.